Again, yeah, I can understand why these questions come up. You only have to look at the action. Yes, Shane, I'm really happy to share my view on this. And more immediately, as we commence November trading, the need to cap BIS gold below 1800 into very strong, unanticipated US physical demand. And this is something that's been missed. There is very strong US physical demand for the October mark-to-market event. And so really this is end up coiling gold for a very large move higher now that this official cap will expire. Now, obviously, we're recording this on Wednesday before FOMC tonight and non-farm payrolls on Friday. So we expected the obligatory spec wrong footing to continue into these high frequency trading algo driven events. But thereafter, for next week, given the paper to physical disconnect, which we can see, we now see the higher official stair steps, although flying under the radar, just now revealed here in October. We see the strong physical driven gold market to accelerate and force higher prices into the end of November. And after this, in December, the Basel III squaring will have to conclude, and any remaining unallocated contracts will have to be fully allocated. And that's important. And by the time this episode is released, will be between FOMC, which obviously I don't have a wizard's hat. I don't know what Powell's going to come out and say tonight. But this will be released between FOMC and non-farm payrolls on Fridays. So unless Powell pulls a rabbit out of the hat that we didn't expect, what I would think is that because his nomination is in question, he's not going to ruffle any feathers into this meeting. And we see really non-farm payrolls as taking a back seat to FOMC. Now, let's face it, the Fed has all the non-farm payrolls data already. And when Powell steps on the podium and the statement to the presser, it's going to be a directional capitulation point at that point. I think because non-farm payrolls data is known, so it will be encompassed in their statement. And the hawkish spin really has already been kind of baked in. And if there are any surprises, it'll play out at FOMC, not non-farm payrolls. So with physical stackers in mind, with the Fed already having spilled the beans later today, the hugely underpriced buying window may well be an optimum time to add positions inside this FOMC non-farm payrolls window. And I say this with stackers in mind. And really, to best illustrate the massive divergence that we were talking about, Shane, a minute ago, between the strong physical gold and silver markets versus the current paper market action, one really has to look no further than the much easier to read silver market.
Awesome. Well, Andy, you're bringing up silver now, and I'm just smiling because of all of the comments. And I have personal friends that are calling me and talking about silver. All of a sudden, silver, silver, silver. And they just loved, that clip of you in the vault and all that. Now, you just shared with us just before going live here that you've got some very important information. That's why I'm saying only in the vault, live from the vault, can you get this type of information. But you just uncovered something this week. Can you share with our community what's going on here and what you uncovered?
Yeah, and this is why it's so good to have this channel. Shane, yeah, this information actually that we talked about before, and I'll spill now, is this information kind of reaffirms what a huge physically driven paper leveling buying opportunity is actually upon us. And you wouldn't see it by looking at this paper chart, these paper driven charts. So yesterday afternoon, which is Tuesday, which is Wednesday here, just as silver was heavily sold at the pit open, and we know what happens, you know exactly where the pit opens. You just have to look at any chart and you'll just see a spike down. And again today, we received information yesterday from one of our largest silver suppliers. somebody that provides the big majors. That Standard Chartered, yep, the very same COMEX market maker, have now tapped out and front run every single remaining ounce of silver not already contractually locked down, leaving zero wholesale supply deep into 2022. So look, let's just kind of sum up what we're seeing in this extremely strong wholesale market, wholesale silver market, because silver stands out. And as we discussed in our last episode, we broke news that Turkey had just come out into the silver market to scoop up some very large size wholesale silver, and that was 2 weeks ago. Now, inside sources had already estimated it was 346 tons had been imported by the third week in October, significantly tightening global supply, and we reliably hear that actually continued into the end of October. But by no coincidence, Turkey's silver buying came off the back of India confirming they had officially imported more silver in just 1 month in September than they had imported in the entire previous 12 months. Now that has to have your attention. This does not include smuggled silver either, which is pretty hard to estimate actually, unlike gold, which the World Gold Council even admit in the past, that it amounts to probably 30 tons of gold smuggled per month. So can only imagine how much this silver is smuggled in. But we're talking about auditable, official import data. So the last time India imported over 500 tons, which it did in a single month, in September, following a 13-month hiatus where they bought almost nothing, September matched a level of imports not seen since April 2020. Now, if we draw a wholesale market comparison, the last time India imported this quantity of silver, it was when silver was trading $10 lower at $13.90. Now, following this level of competitive buying, silver actually rose $16 to $29.9 over the next 4 months into a very similar supply shortage. In fact, we've not seen such a supply deficit since March 2020, where silver was at $12, and it telegraphs much higher silver prices. So don't be fooled by this absolute counterintuitive behavior that we're watching right now. And also, what is little known is that China has been importing silver, as well as China non-monetary gold imports from Switzerland have now auditably exceeded imports from 2019 and 2020. And I'm sure that's Basel III related. But that doesn't account for hidden central bank monetary gold buying, which we know referred to many, many times, at least exceeding 25,000 tons, if not more. But we're talking about auditable stuff here. So Shane, regarding silver, when one considers that this extreme tightness in upcoming silver availability now stretches deep into 2022, just off the back of Standard Chartered aggressively locking down 2022 supply, and then compare that to the counterintuitive COMEX-centric paper silver action evidenced yesterday and today into this FOMC gaming, it leaves little doubt that current dislocated silver prices are going to be very short-lived. Silver is so compressed for a large physically driven move higher at this point. And what we're seeing in the COMEX-driven price action is COMEX pit sellers. This is important to understand. How is that possible? How is all of this physical buying going on, and forward buying supply deep into current dislocated silver prices are going to be very short-lived. Silver is so compressed for a large physically driven move higher at this point. And what we're seeing in the COMEX-driven price action is COMEX pit sellers. This is important to understand. How is that possible? How is all of this physical buying going on, and forward buying supply into the deep into 2022. How come the price is collapsing? I need to explain that. It's the pit sellers tricking the specs into selling, and I'll explain how that works in detail. But these non-market making participants, they have no visibility into the offsetting spot index physical related longs that are supposedly hedging these COMEX shorts. So as we evidenced yesterday by this market maker, Standard Chartered, offsetting, what they were doing was they were buying spot silver, and they were then offsetting the COMEX shorts with this smoke and mirrors over the counter longs, which are acceptable in the CME's eyes. Now, so psychologically drained spec sellers are tricked into believing, because they see just one side of this equation, that these COMEX sell orders that come raining in are naked short bets. But they miss the fact that on the other side of these COMEX short sales, insiders are busy locking in, spot indexing, buying, in other words, silver at every refiner and producer we have spoken to. And so, I mean, it has to be understood that the momentum-driven spec silver future sellers, they've tricked in the spec short sellers, and they just don't see that the largest silver buying versus the tightest silver shortages evidenced since March 2020 are actually upon us. And what they're reacting to is the blinkered view of just one side of a transaction, namely the short sold COMEX hedge positions being added from the likes of Standard Chartered and others who are going long spot over-the-counter silver positions. This is driving the paper to physical disconnect to a point not seen since March 2020. I cannot say this enough. So very, very short term, following this race to physical, European refiners we spoke to already, such as Argor, will have no supply for sale in the new year at anywhere close to current prices. This makes this counterintuitive, gamed, blinkered silver discount